I mean, it's so you can plan out the year and at least come up with what the outcomes are going to be, and to your best knowledge. So it's kind of like I guess, a roadmap for what you want to do for the year.
Yeah, it's planning purposes.
That work, Rick?
Yeah, that'll be fine. And what else does it do?
Discipline.
Discipline, accountability. You hold somebody, you just come up with a budget, hopefully that they help participate in developing, and then you can hold them accountable. What else?
Maximize the usage of the sources.
Okay, yeah, absolutely. You've got limited resource, you gotta figure out how to use it. What are your priorities? What do you do? Let's do that. Let's put this down here: goal setting, planning, accountability, resource allocation. Okay. What? Any other reasons? I think we hit the ones I had picked up there. It's really important in my mind to determine where you want to go. It was Alice in Wonderland. She asked the cat, said, what was her term? How do I get there? And she said, well, where are you going? And she said, I don't know. And he said, it doesn't matter. I mean, yeah, it matters to us where we're going. That's not literally the translation, or something like that. To any organization, it matters. To a family, to an individual, you should do some planning. That's what the budget process is all about. So, despite their attitude about being flawed, you can do it effectively, or you can do it crummy. I mean, sometimes it's just a process. It's a waste of time. If you deal with the right goals in mind, it can be a very important tool for you. Preparation period, that varies. So in Seward County Hospital, we have to turn in our budget a year and a half before this year starts. That's a whole long period of time. A lot happened that year and a half that can change things. We do because we're in county and they tell us to. Top down or bottom up. I really think this is where it becomes an effective tool or not. I've been in organizations where they basically said, this is your budget, deal with it. And I thought, my gosh, where do you guys get up these numbers? Where do they come from? But what do they translate into action plans? And there were none. Or you could go with from the bottom up and work with the people who are really on the street operating the programs and get their ideas. I've been involved in a lot of turnaround facilities. Fort Walk might be one of them. But where there were real financial problems, I found the most success was going out to the departments and talking to the Department of Radiology director, or even to the imaging techs, and talking about, if this was your company, what would you do to make it profitable? I think he came up with some pretty marvelous ideas. We turned some hospitals around, significant ones, and not anything management did, but empowering the employees to say, here's how I would do it. Say, you waste so much money doing this, you waste money buying it from this vendor, whatever the ideas are, but you listen to them. So from my perspective, bottom up is the right way to budget. As they do that, they've got that emotional buy-in to it. It's their budget. They respond to it. They're protective of it. They know what it's all about. They know what goes into the assumption. It's very effective. So I personally think that's the way to do it. Department involvement, considerations. You think about statistics, historical information, future planning expectations, company plans, goals. There's a lot of things you can think about there. Audits. And for some people, that's a curse word. But tell me what you know about audits. What's the purpose of an audit? Is there a purpose?
Almost like a check and balance, like just making sure that there's internal audits and like external audits, depending on, like your internal process auditing, the institution to try to protect yourself from risk at a later date, or reduce your exposure, and then the external audits from, the public accounting firms or the government.
Sure. I started my career as an internal auditor for Kaiser Permanente out in California. It was fascinating because I got to see all parts of the corporation: optical, construction, hospital, doctor practices, everything. A great place to learn. Then we had external auditors too, and one of my fairly recent jobs was with a CEO who did not like auditors. They felt like we should not share anything with them, that they were our enemies. And I thought, say, Bill, they can be our greatest friends too. But there's different attitudes about it. But let me give you some examples. These are just some things I printed off. Corporate scandals. Have you heard of Tyco International? Big accounting fraud there, improper accounting, millions of dollars. WorldCom, maybe you remember the default of WorldCom, operating cash flows. And I think the WorldCom was an accounting firm, I think, was also involved in that. Was that Anderson? Anderson. Okay, Arthur Anderson. No, that was huge, millions of dollars. Enron, Fannie Mae, Halliburton overcharging the government, Health South, one of our healthcare companies. They've recovered, they've done a good job, but they were going through a lot because of some of their accounting practices. Lockheed, Nortel, I mean, there's pages of accounting scandals and fraudulent activity. Auditors are supposed to help protect against that. Now, occasionally you'll get the Arthur Andersons that were a little bit too close to their client and didn't live up to their responsibilities. There's some other notes in here, accounting for similar problems that almost bankrupt the company. KPMG was one of the big ones with Xerox, alleged accounting irregularities. That's why auditors are there, to do an external audit, independent review, to make sure your financial statements are prepared properly and correctly. And they don't have enough resources to go through and check every transaction that happens. But they pick out, they have their accounting methodologies, they do their samplings and so forth. The bottom line result at the end, they say, we can't verify that every transaction is correct, but all in terms of materiality, company X is presenting their financials properly. So that's a big part of it, to keep us honest, keep us consistent, make sure that our reports match or similar to some other companies' reports. I mean, if it left up to us each individually, we'd have a million different financial reports out there in terms of what we report now. So they've standardized for us. So that's a big, important part of it.
Isn't there also a part of that annual report, the audit report, that's addressed to management?
Yeah. Let's get, I'll put an item, the fourth down, management letter. Oops. At the end of that, they write their management letter. I hate those. No, I don't really. They come back and summarize any significant findings they have. There's categories of how significant it is. And they break them down. They say, okay, we found out when I got dinged on last year. It was a very small hospital. I've got one accounts payable person. This is my accounts payable person enters the new vendors, prepares all the payment invoices, processes payments, and so she basically does the whole works. And they're concerned that if Sue was dishonest, she could put in vendors. It could be her sister, it could be her father, it could be whoever, and no one was checking on it. And so they came up with some recommendations in our management letter saying, this is a weakness in your span of control. And so now I review all the vendors, all accounts payable, I sign off on every invoice, my favorite part. So we have certain checks and balances in place, and so that's the kind of thing that they do. Management letters good. It was a clean management letter, I just love it. I just don't get enough of those clean ones. They're paid to find things wrong. And honestly, I kid about it, but I'm grateful for that because it makes sure that I'm doing a good job. If something goes wrong, I can say, hey, we checked that. I mean, somehow it got past us, but it got past us, it got past auditors. We've got controls in place that is important. So it protects us as well as it gives us some good, meaningful information. So I'm not against auditors. I think they have a very important purpose. Who are the users of that information? Certainly management better use it. I think they're missing a great opportunity. But you've got a lot of external users. It depends on what kind of company you've got. If you're an investor-owned company, your investors want to know how you're doing and that you report things fairly and accurately. It could be external lenders. You know, people want to see our audited financials before they talk to us about lending money. There's a lot of users for financial information, and that's the value of external auditors. Also, auditors will prepare your cost reports if you're hired to do that, and we do. The cost reports got to be really quite science. And so we have our Medicare and Medicaid cost reports, but that's all part of the audit process. It's beneficial. Financial reports, as a manager, and I don't know what levels you've gotten involved in financial reports, but what value are financial reports to you as a manager in your operations? Do you use them? Who has any exposure to it this way? How do you have exposure yet? Okay. Well, you prepare them too, don't you?
Yes.
Okay. Let me ask her to ask you, how do you use financial reports? What meaning do they have to you?
I'm on the physician side, so we use them to look at how productive our physicians are being or our service lines, and then in conjunction with the hospital, sort of melding that together to do a combined business plan to see like if our new clinics are doing well, if our downstream is coming back, and then how that's affecting our revenue.
Okay. Good. How do you want people to use the report you spend so much time on?
Well, we use them for everything from our MORs to practice administrators who will review with individual doctors. But I mean, it it can tell you a lot about the performance. I mean, you can find your regularities like coding, if worker we use don't match your reimbursement limits, stuff like that. So I mean, they tell us we use them daily.
Yeah, there's so many ways to use it, but it's all to help you manage the company. Again, without money, no matter how smart you are, you're not gonna have a company to manage. So no matter what your position is, finances should be important to you. You should be using that information. When I got to Memorial Medical Center, our department heads hadn't seen an income statement for their department for I don't know how many years. They had no clue what I was talking about. So when I go out there and talk about how do we control costs, they say, I don't know. No, I don't know what the costs are. It's so important that they're involved in it. Even now, after 2 years, my CEO and I were talking last week. We were in such a rush to produce the financial reports, get them out to the board, present to the board, get on to the next project, so we don't really take use of that. We don't sit down with the MOR report and say, okay, here's an area to work on. It's something we're working on personally because that's so important. But you know, you can get caught in the priorities, and it's just important to do that. Okay, I'm sorry. Financial reports. Why are they important? What kind of information the person wants to get out of it? Who is interested in it? Types of financial statements. Okay, what are the financial statements? What kind of financial statements are out there that you would use?
Income statement.
Income statement. Okay, very good.
Balance sheet and cash flow.
I'm sorry.
Balance sheet and cash flow.
Okay. Balance sheet, income statement, cash flow, others, and there's all kinds of ad hoc or special project ones. Financial priorities. As you prepare, as you use financial information, what's your priorities? I'll take the easy way. I'll give you some ideas. I said that it should be accurate. You know, what good are financial reports that are? I just read your list of fraudulent financial reports and the problems that cause lots of people. You can't consider all the investors in those companies impacted millions of people. Accuracy, timeliness. I was used to getting things closed in 3 days. In Port Lavaca, we have a 10-day close. Well, that's good, but half the month is, a third of the month is over before you have financial reports out. You've missed a third of the month to react to things. And so our systems, we're working on them, trying to make them faster, but that's the process. Timeliness is important. Credibility, user-friendly. For a non-finance person, you've got to put it in language that they understand. If I give you a general ledger and you're not a finance person, you say, what does that mean? You lose interest real quickly. So it's part of our responsibility as finance people is to put in a format that you will read and say, oh, that makes sense to me. And then creative. I don't mean creative accounting or accurate accounting, but creative in how you do it, whether you do bar charts or pie charts or whatever, how you do it to make it interesting and creative, and that's important. I said that's one of the multiple choice questions, not one of those things. You really need to do all. Timeliness, accuracy, credible, friendly, user-friendly. It's important we do that. And if you, as a manager, see reports you don't understand, talk to finance people and say, what is this supposed to tell me? Is there a better way to tell me this? Because we had that responsibility to be on that one. I'm going to go through these pretty quickly. I'm not sure how our time is. I don't want to waste too much time on this. We use a lot of accounting terms. Here's some of the prepaids. Okay, I'll quickly say what each of them are. Prepaid as an example. So if I pay an insurance policy premium, that's good for 12 months. I could take that $15,000 and book it all in January when the policy starts when I make the payment. But that's not a real reflection of the value of that insurance policy. It's really good for me for 12 months. So I put in prepaids, expense over 12 months. That's a prepaid. Cash versus accrual accounting. Our accounting operates on a cash accounting process. We do accrual accounting because we're always constantly trying to match our records with theirs. Cash is usually what happens. If you bill for a $10,000 surgery procedure, accrual accounting will put $10,000 as revenue. On a cash accounting system, when we get paid $3,000 or whatever we get paid, we book that. You recognize cash on the one hand, on the other side you recognize the value of it when it happens. So there's a difference between, is that a good explanation or a decent thing? Okay. Physician revenue guarantees, we're recruiting physicians all the time, and one of the tools we have used in the past is to guarantee a physician a revenue. I don't know how you were recruited, but we guarantee if so for the first 2 years, and we'll say you'll have guaranteed at least $200,000 or whatever it is, depending on specialty and so forth. And then they can work out so many years afterwards to pay that back to us. And after they work 2 years, they work for 2 years at a revenue guarantee. there were 2 more years of time to pay it back to us, and at the end, there was nothing legal, it's just a one-way to recruit people. We're doing a different approach now because we're finding physicians generally are looking for more employment models. Some of them still want their individual practice models on it, so we were trying to deal with the changing priorities of a physician to make us a welcome place to come practice. But that's one of them. Direct versus indirect costs. Direct costs is something that in my department I choose to spend money to buy a magazine subscription to CFO magazine or something. That's my direct cost. If my CEO, that may be a bad example because I don't produce revenue, I just produce expenses of finance. If I'm in radiology, I might subscribe, I might buy my films from Mary X-ray or whatever. That's a direct cost. If my CFO decides to subscribe to CFO magazine, and then I have to allocate my costs out because I don't produce revenue on Medicare cost reports, that becomes an indirect cost for radiology. That's what that is. Inventory depreciation, those are just terms. I apologize. I just don't want to take too much time on those. Balance sheet. What does a balance sheet tell you? And does anybody have a personal balance sheet at home?
Yes.
You do?
It tells you your net worth.
Okay, good. I don't want to see my net worth, my negative net worth. But it basically tells you, how do you report that? What do you take into consideration to consider your net worth?
All your assets and all your liabilities.
Okay.
What
Is
you've
that
got
any
in the
different?
ends.
I'm sorry?
The formula is your salary times your age divided by 10.
Does it? Yes, okay.
It
shared
gives
that
you
with
your
me
personal
not
net
too long
worth.
ago. And then it shows your personal net worth.
What it should be.
Yeah, right. Doesn't always equal what you want it to be, but it's
Yeah.
there. What does a balance sheet tell you when you're preparing it?
That's basically just your assets and your liabilities.
Okay.
Basically, I mean, where you stand, really. I mean,
Does your net worth?
yeah, it's just a snapshot of that time.
Yeah. So it can change from day to day?
Yeah.
Of course it can. So a balance sheet for Dan Martin's personal balance sheet or for Texas Children's Hospital basically tells the same thing. Numbers might be a little bit different, but it basically tells you your net worth. And so for a facility, we'll take it for a facility. The balance sheet it's a snapshot of the company's financial position, showing your assets, your liabilities, and your net worth. And those are the 3 important things. At any given point in time, we typically use a month or a year end for our balance sheets. We hardly do it on the 12th of each month or whatever, usually the end of the accounting period, and that's when we do it. It summarizes the wealth of the company, defines what the company owns, which are your assets, property, cash, investments. That's what you own. That's important. That's the way you have to operate on. And how those assets were acquired. We have an MRI machine down in Fort Lavaca as well. And we were the first in the state of Texas, of all things, to get this particular kind of open MRI machine. We're pretty proud of it. Since the others have caught up with us, but here just pulled up down 12,000 man that are newest in technology. We didn't have the money to buy it, so we leased it. So we show that as an asset because it's our asset to use. It shows up under property, plant, and equipment. But we all show under liability how we finance that, and that's a big lease. And so we're paying on that dearly every month. But so you have to; those things have to balance. In fact, that's the next thing. Assets must always equal liabilities in the fund balance. And so your assets is what you own. Your liabilities is what you did to get it. The stealing doesn't count. You have to buy it somehow. Buy it, lease it, whatever. It's what you owe a third party for it. Or if it's not a liability, it's a net asset, and that's what you've accumulated through cash or donations, that type of stuff. That's what the company still owns debt-free. Now you could have some obligations. You could have a donation that's restricted for a certain use. We had one of our physicians recently, he was retired as one of a visiting radiologist, and he knew women had difficulty coming up with money in our community for mammographies. And so he gave us a pot of money and said, okay, I want these thousands of dollars to be restricted to pay for the women to have mammographies. That's a restricted donation. We report that as a net asset, and we can't just go ahead and spend it on whatever I want to. I have to spend it on what the donor designated. So that's an example of that. Balance sheet is very important. So yeah, this is a financial. I don't know how well you can see that, but this is our trend. We call it a trend report because it covers more than a month. But Here's our balance sheet. We start out with cash equivalents. Cash is considered something that you can turn into cash within a very short time. It can be a money market, it can be something where you can convert it quickly. We have some cash equivalents. We've got a certificate of deposit of $500,000 as an example. We can convert that to cash pretty quickly, so I'm allowed to consider that as a cash equivalent. I'm sorry, my investments, I lied to you, here's my investment right here. That's my $500,000. It depends on who your auditors are. We could convert that pretty quickly. There are some restrictions on that, so that's why I consider cash. But it's up here, accounts receivable. We have a ton of accounts receivable out there. We know we're not going to collect on all of it, so part of this we call a contractual, or allowance for contractual, so we're going down and then sorting out accounts receivables, this number. We have other receivables from other parties. We have our inventory, our prepays. All these make up our current assets, and that's a part of a big ritual analysis to talk about that.
Oh, boy.
Cash restricted by donors, contributors and grantors. We don't have anything left for the doctor's money that he gave us. It's been used up for mammograms. Then our property, plant, and equipment. We use depreciation to value that. You know, if you buy something a car brand new, you drive off a lot, it's already been depreciated. Then you see over the course of 3 years, it'll be fully depreciated. Laptop computers will probably depreciate the next day. You change technology so fast. But you give a useful life to a piece of an asset, a piece of equipment, and then you use that depreciation, that useful life, to spread the value of that equipment over 5 years, 10 years, whatever. Building might be 40 years because you don't change buildings very often. The structure of your setup makes your total assets. Get down to your liabilities. We have current portion of long-term. That's our MR lease, our MRI lease. We have a note payable, accounts payable to multiple different vendors for whatever. It could be food, it could be hospital supplies, equipment. Payable third party, that's the government, that's the Medicare. You can see sometimes our numbers got up to pretty high, 680,000. We manage that very carefully because we managed so well in the past. But these are liabilities. Here's how we can afford to buy all the assets up there. And then we get down to our net worth is down here. This is the accumulation of all those earned and retained in terms of our values. That's important to us. That's a balance sheet. That could be a single page. So this is just a trailer for not buying this that way. As we look forward, current assets can be exchanged for cash within 1 year. Cash is restricted and it's used to be used for operating other purposes. Accounts receivable. That's a big one for us. You know, we put so much out there. We had $1 million auditing adjustment last year. It just knocked our socks off. It wasn't in our favor. But as our auditors came in and reviewed our accounts receivable, they said we overvalued it by about $1 million. And the thing is that it all comes down to how we value our contractual relationships. When we have a contract with Blue Cross as an example, we take a look at our Blue Cross accounts receivable. Do we allow for enough contractual adjustments because of the contracts we have? Ours, we got hit with a private pay. We were valued at a higher level than what the auditors thought they were worth. And they did some studies, and they proved to me that we overvalued, not purposely, but historically looking at our cash collections against private pay. So accounts receivable is big. Investments, expenses, they represent excess cash. Property, plant, equipment, that's what we invest into our company to produce the revenue. On the liability side, current things to be paid in 12 months, long-term, longer than 12 months. Equity fund balance equals the contributions and earnings of the company over the life of the company, and any restriction on those, the use of those things. Income statement, what's that mean to you? How do you use an income statement? How do you use your own personal income statement? Do you prepare a personal income statement? I used to.
Higher performing.
I'm sorry?
Higher performing, so like how much money you're bringing in versus how much money you're spending. So
Exactly.
Are you being successful?
How often do you prepare that?
Do what?
How often do you prepare an income statement?
Monthly.
Yeah, most of the companies will do it monthly. They have an annual one. But it basically tells you how you're performing financially. A balance sheet is a snapshot in time. The income statement tracks all those activities over time. Financial company, the performance of the company, our activity given a period of time. Reports the financial operating effectiveness of the company during a specific period. It shows how stable you are, how viable you are, how predictable you are. There's different categories of these. Again, I'll probably highlight, this part is what makes up a big portion of your income statement as a healthcare institution, and it's such an important one. And this is what we track probably most carefully during a given period. Contractual adjustments, where we have contracts with the payer, Medicare, Blue Cross, whoever. Discounts that we give to people for different reasons, a prompt pay discount just to encourage cash to come in. What we write off to charity or that. Bad debt, I told you we write off $560,000 a year, a month, excuse me, bad debt, that's huge. For a small place, and there's other projections. Expenses, those are costs incurred to generate the revenue. There's other non-operating income and expenses, and they don't relate directly to your operations as a hospital. It'd be investment income, investment expenses. It could be donations and contributions. They don't relate to running a hospital, but certain things you have to report on your income statement. See if I can pull this up. Some of my links didn't work. Okay. This is what we show as the income statement. Again, we report actual this month, we compared the budget for this month and what we were at a year ago, kind of puts it in context. And then this is the current month of this year to date. So this is what we report on general terms. We drill down farther than that with departments, the inpatient, outpatient revenue, contractuals. We have our other operating revenue, which would be dietary, we sell cafeteria meals, that kind of stuff. Then we get down to operating expenses. You can break these down any way you want to. These are the ways we find most useful for us in large categories. Depreciation, total expenses. Then we go into our non-operating revenue and expenses, investment, interest, contributions. Intergovernmental transfers, that's something we mentioned before, but we have to account for that. And then, as you can see, I don't remember which month this was, but we were making money, so top dollar, that was pretty good. But income statements are important. And if you relate to your own family situation, you can see why, because you need to know as an individual whether you're making money or losing money. It's hard to go out and buy a new car and find out you've got no cash. Some things that look for changes, basically changes any of these month to month. You want to know why they're changing, or why they're not performing up to the expectation, or why you didn't perform as well as last year at the same time. So there's different ways to do that. Special reports, put them all up there at the same time to talk about it briefly. Okay. General ledger, we call that the Bible of accounting. That records every transaction, financial transaction. Boring, if you're not interested in that stuff. For me, it's important because I understand it. But if you look at the general ledger and say, oh my gosh, just kill me, But it really is important because it tells you every transaction that goes through financial records, everything that happens. So it's very important. When a department head says, how come my expenses are high? I go to the general ledger. I sit down with them and show them why it is. Now, the general ledger is made up of your accounts payable, it's made up of your revenue, it's made up of your salaries, it's everything in there. But that's where you go as your general ledger. Cash flow, what was mentioned earlier, excuse me, we talking to our auditors recently, they told us about those horror stories where a CEO had been replaced fairly recently. And every month he goes to his board reports and really finds fantastic financials. And then they had to shut down the hospital because they had no cash. He didn't report cash. He reported income, he reported all kinds of stuff, but it didn't show they didn't generate any cash, and so he ended up closing the hospital. Cash flow is very important, and there's certain measurements of how many days of cash you should have on hand, and it basically is saying if I got no more cash for today for the next X number of months or weeks or whatever, I could operate for 56 more days or 62 more days or whatever it is. It takes us about $56,000 to operate our hospital every day. Sundays, Mondays, Tuesdays, holidays, Christmas is going to cost an average of $56,000. I know I've got to be bringing in at least $56,000 in cash, or I'm in the hole. So cash flow reports are important. Department reports we talked about, that's where you get the department head involved and accountable for performance. Payroll, these are other things that make it up. Payroll, cash disbursements, accounts payable, other reports that are important to us. And maybe in your management role, you'll find a need for some of these reports. And it's really what you want to know, and ask your finance people to provide that for you. When I was in healthcare finance years ago, I was impressed by a guy named William Cleverly. He's out of the University of Ohio, I think, and he talked a lot about financial ratios. And he just, every time he went to one of his seminars, and financial ratios all over the place. Do you know the value of financial ratios? What value do you have? What good are they to you? Why would you ever want to look for them?
They can quickly point you in a direction, like you may not have time to look through, you know, all of your ledger or every single detail, but you can run some ratios and they can kind of narrow your focus a little bit to maybe a problem area or a successful area and kind of dig deep into it from there.
Very good. Anything else? It gives,
Snapshot of the balance sheet.
yeah, it gives you a snapshot of the balance sheet. It really allows you to take certain parts of your balance sheet or your income statement and relate them to each other. Like salaries is a percent of net revenue. You can see where your revenue is, or what your level of salaries are. And maybe you find out you're paying too much in salaries for the revenue you produce. Or benefits is a percent of salaries. So looking at those, or you look at your current ratio, your current cash on hand, how far that would go to pay your current liabilities. Then hopefully you've got enough cash on hand, so you've got a favorable current ratio to tell your current liabilities. But they're good, they're snapshots. You can compare Port Vaca Memorial Medical Center against Texas Children's Hospital, and we'll be calculating the same thing the same way. Different numbers, they're billions and we're millions, but we're calculating the same way. So if I want to look at the current ratio of Texas Children's Hospital or MD Anderson, I can compare where they stand to Port Vaca or Citizens or Detour Hospital Victoria. That we use the same calculation, so it's standardized information. You get a lot of good information out of that. So it's you can compare industry to industry. I can look at healthcare versus car dealership, I suppose. There's a lot of things to consider in that, but it gives you something standard that can be translated from one industry, one company, even your own company over time, to see if you're doing better or worse. It really helps out. It's there's a number of them. I put a liquidity, accounts receivable analysis. That's a big one for us. We measure the number of days and receivables we have outstanding. And the days outstanding, it basically says it takes me 65 days to collect accounts receivable. Well, I've been in facilities where it's been over 120 days. So you want that in short periods of time. It shows you just how effective you are in collecting receivables. Capital structure, how much debt you've got versus the capital assets you've got. Profitability talked about. All these are different ones, but they're important to use. I came across one that's called the fitness test, and I was kind of impressed with that. It takes these six ratios, and they say this is a fitness test for any institution. And if you do go through these, it gives you a pretty good idea of how profitable and how effectively they run they are. Your operating margin. I don't know if you want to go through some of these, but these operating margin, it measures the control of operating expenses relative to your operating revenue. So take out all your non-operating stuff. What's your expense compared to your operating revenue, and how effective is that? And then you can compare this. The particular one I have is Memorial Medical Center 2012 versus where we were in 2010 versus our peer group, which other comparable size hospitals, locations, versus the whole state of Texas for critical access hospitals and the median of critical access hospitals across the United States. So I can compare myself to a hospital in West Virginia, and I can see how they're doing relative to how I'm doing. And it lets me know am I performing relatively well or not, and where I need to focus my attention. So that's a good one. Liquidity, days of cash on hand. If I don't collect another dollar for next month, how many days is it in business? A capital structure that you're equity financing, the percentage of your total assets that's financed by debt. You don't want that to be higher than it has to be. You can be over leveraged by too much borrowing, put yourself in real hot water cash flow wise. You may have a great income statement, maybe generate lots of cash because you've got all this great equipment, but you go broke in a couple of months because you're paying so much for these leases or capital purchases. So that's a good one. Your current ratio measures the number of times short-term obligations can be paid using your short-term assets. Like going back to that cash versus your current assets, accounts payable, payroll, so forth. Do you have money to it? So these are all meaningful ratios. I think that they're good to be mindful of. As managers, you may not want to sit down and look at a general ledger, but you might want to look at some of these ratios and give you an idea of how you're doing against where you were a year ago, how you're doing against a competitive hospital across the town from you. Dashboard indicators. By the way, can we take a break part way through? If we do, tell me when I'm supposed to give you a break.
Yeah, if you want.
I'm sorry?
It's up to you.
It's up to you guys. I'm sorry, I'm not sure if you're used to it, if you're used to it.
No, I just push them all the way through and then we quit a little bit early.
Okay, is that okay?
Yeah.
Feel free to get up and walk out if you want to. Just don't be too rude about it.
You got about an hour yet.
Okay, but I want to get in some kind of homework assignments, because I think that might be valuable in how we talk about some of these things. Is that okay with you?
Yep.
Is that in your goal?
Yep.
Dashboard indicators, again, this is just a way to report information in a user-friendly way. And I've seen lots of different dashboards, but some of the typical ones, you put operating indicators that's meaningful to you and the other managers. It may not be meaningful to every manager. They may want to look at accounts receivable, may want to look at their days of accounts receivable as opposed to capitalization ratios. But so you take and look at your management structure, particularly senior management, say, okay, if you want a snapshot of where we are today, what information would you want to look at? And that's kind of what your dashboard will represent. And it varies, like I said, it depends on your senior management, what's important to them. Patient days, I look at patient days every day. I see that we have X number of patients in the house. And as we get up to 25, I only have 25 beds. I start worrying about what we'll do if we have more patients. If it gets too low, I worry too. Days cash on hand, cash receivable days. We've talked about some of these things. But again, the dashboard indicator is what's meaningful to the manager, or whoever you're reporting to, or whatever role you take in management. And you tell your finance department, say, I want this included. But it's not just, I relate to the financial dashboard reports. There's other dashboards reports like on quality. A couple of you indicate interest in quality. We have a lot of dashboard indicators for quality, number of prescription errors in a month or whatever, number of patient complaints, number of bad outcomes in surgical procedures. I mean, you define what's